On February 28, 2026, commercial traffic through the world's most critical energy choke point came to a complete dead stop. Global oil supply shows a sudden steep drop at the end of February. 11 million barrels vanished overnight, and this surplus came from national savings accounts. Superpowers like the United States and China authorized massive, coordinated releases from their strategic petroleum reserves. Injecting millions of stockpiled barrels into the market successfully padded the shortfall, hiding the true physical deficit from everyday consumers. But that abundance is a temporary cushion. These stockpiles are draining rapidly, starting a ticking clock on the global economy before the physical shock hits. This diagram shows the market split. The top pathway, unrefined crude, is buffered by reserves, but the bottom pathway, refined products, is restricted. With export refineries trapped by the blockade, global shipments of critical fuels like diesel and jet fuel have been cut in half. This led to severe fuel rationing across Asia and an escalating jet fuel crisis in Europe. The crisis extends to the very foundations of the food supply. The Gulf produces 30% of the world's ammonia and handles about a third of its internationally traded fertilizer. Choking off those exports has triggered cascading shocks, with urea prices spiking by 60% and industrial base metals hitting all-time highs. When shipping through the Gulf stops, the physical inputs for global agriculture and heavy industry break. The fallout reaches far beyond the fuel tank. National strategic reserves are finite, and they are depleting faster than they can be replaced. Projections suggest these reserves will be largely exhausted by mid to late 2026. At that point, the daily 11 million barrel deficit will hit the global market unmitigated. Stripping away that buffer will trigger a massive price reversal, sending energy costs soaring far past their initial March peaks. The world is transitioning out of a period of managed stability and into an era of forced scarcity. Economists refer to this phase as demand destruction, the point where prices rise so high that poorer populations are simply forced to stop consuming energy entirely. The World Bank forecasts that developing economies will face average inflation rates over 5.1% throughout 2026. This inflation is driven by the fertilizer shortage, which destroys crop yields and erodes farmers' incomes globally. The human cost of this disruption is high. The World Food Program estimates that this chain reaction will push up to 45 million more people into acute food insecurity. The maritime dispute in the Middle East has triggered a global debt and starvation crisis for the developing world. There is a common assumption that a peace deal or a sudden reopening of the Strait of Hormuz will instantly fix the market. However, the physical reality involves a severe operational lag. It will take at least 6 months just to recover to 80% of pre-war capacity. Repairing damaged extraction infrastructure, paying exorbitant war risk insurance premiums, and clearing thousands of stranded vessels are all hurdles that prevent a quick restart. Navigating this choke point remains a logistical nightmare. Small, fast speedboats utilizing asymmetric naval warfare tactics continue to present a highly unpredictable risk to large commercial ships. The 2026 crisis reveals the fragility of global free trade, serving as a brutal dress rehearsal for an interconnected world that can simply no longer assume energy abundance.